Good day, everybody. Chris Herline here of REAP Financial coming to you with this week's Wealth Report. It is December 5th, 2025. Hard to believe, but we're officially in the home stretch into the year here. The holidays are right around the corner. Families are gathering, and typically this is where we start to reflect on the year we've had and look forward to the one coming up. And I wanted to take this moment before the holiday rush really kicks into high gear to just visit with you quickly and talk about exactly where we stand. We've had a lot of conversations in the office lately about the noise in the headlines versus the reality in the stock markets. And I want to give you our direct, really unfiltered conviction on what we just went through, and more importantly, how we're positioned as we go into 2026. If I had to describe 2025 in one word, it would be resilient. And truth be told, the economy really sputtered through much of this year. It wasn't a straight line up. A lot of you probably remember April when the tariffs and trade shocks hit the news cycle, and it caused some real turmoil in the markets, and there was fear in the markets. You probably felt it, and we certainly saw the volatility on the screens. But here's something really important to understand. The worst case scenarios that the media was screaming about, they didn't happen. While the higher tariffs did create some drag on growth and push prices up a little, the American economy didn't break. It bent, but it didn't break. In fact, as you're listening to this broadcast here on December 5th, we are seeing strong signals that 2026 potentially could surprise people to the upside. We believe growth is likely to exceed expectations next year. So the question is, what's going to drive the growth? And we believe it comes down to three things: policy, innovation, and the consumer. If we look at policy, we're looking at the One Big Beautiful Bill Act, that OBBB that I've talked about, and that's really kicking into play in 2026. These tax cuts are designed to be a shot of adrenaline for the economy, and we believe that this fiscal stimulus should at least offset the tightening effects we felt from the tariffs and federal spending cuts earlier this year. Simply put, it puts money back into the hands of businesses to hire and invest. Then there's innovation, and we cannot talk about this economy without talking about AI, artificial intelligence. Throughout this year, 2025, massive spending on AI was the main pillar holding up the economy. In fact, there's studies out there that show that if you strip out the AI sector, the rest of the economy barely grew or even contracted. So it's been a tale of two economies. But looking ahead to 2026, that AI investment is now maturing. It's moving from just building chips to actually changing how companies operate efficiently. However, we do have to be realistic about the labor market. It's a mixed bag right now, and we're seeing fewer new jobs created. Now, part of that is due to immigration policies that have tightened the workforce supply, and part of it is that AI is starting to reduce headcount in certain business areas. But, and this is a big but private sector balance sheets are healthy. American businesses and households are actually in good shape compared to historical averages. But now let me shift to your household for a second. There's something we've seen this year called the wealth effect. And when you look at the value of your assets, you look at the stock market, you look at gold, assets have appreciated this year. And when people feel wealthier, they have more confidence to spend. And since consumer spending drives 70% of this economy, that really matters. So unless we see a substantial market decline, which we're not anticipating at this point, retail spending is likely going to keep going up, rising right through this holiday season into 2026. So the consumer is strong. But what about the Federal Reserve? This is where having the right financial partner matters, because expectations really must be managed. Yes, the Fed is showing signs of cutting rates, which help interest rate sensitive sectors like housing, auto loans, that kind of thing. But I want to be clear with you. We do not believe the Fed is going to cut rates as aggressively as maybe the broad markets think they will. The reason for that is inflation is still a wild card. It was falling nicely towards the Fed's target, and then the tariffs bumped it up. If growth explodes in 2026 like we think it might, that puts upward pressure on prices. But what's interesting is the Fed is doing something else very important that isn't getting enough headlines. They're currently pausing on quantitative tightening. So in plain English, for a while now, the Fed has been taking money out of the economy by selling off bonds. So right now they're pausing that, and that means they are stopping the drain, and that keeps liquidity in the financial system and supports asset prices and future growth. So how is our team at REAP Financial going to navigate this? And the answer lies in conviction and global diversification. If you look only at the United States in 2025, many investors miss the big picture. Investors who suffered from what I call a home country bias, only buying U.S. stocks, missed out on massive opportunities. Reasoning behind why many of our portfolios did well this year is because we invested around the globe. We saw that markets outside the United States were selling at much lower valuations. They were essentially on sell, and we capitalized on that. We also benefited from currency trends. So as foreign currencies appreciated against the US dollar for much of 2025, that boosted returns in many of our portfolios. While the big US growth companies had a good year, many non-US stock markets actually generated higher returns. And it wasn't just stocks. We had strong conviction in other things like gold and energy. In these asset classes, many of them outperformed US stocks, and having them in your portfolio can provide a safety net and a growth engine at the same time. That is the power of diversification. So here's the bottom line as we close out the books on 2025. I believe we're entering December with a strong tailwind, and we expect these trends to continue into 2026. We're not chasing yesterday's winners. We're positioning for tomorrow's reality. We want to see investors diversified across the globe. Our team is watching the Fed's balance sheet closely so you don't have to, and we are monitoring the inflation data to make sure we stay ahead of this curve. The reason so many of our beloved clients like you have chosen to work with REIT Financial over the years is because you want a team that isn't reactive, but proactive. I hope you and your families have a wonderful start to the holiday season here. Enjoy this time, relax, and know that we're watching the markets for you. We're looking forward to finishing this year strong. Until we speak again, all the best.